Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio of Christian Salomone, Chief Investment Officer at Ballast Rock Private Wealth, to discuss the uptick in interest in private credit investments. Christian, it's great to have you with us. Welcome to Trade Talks.
Thank you so much for having me.
There certainly has been an uptick. I feel like this is all we're talking about right now on Trade Talks are the private credit opportunities. Tell us more about Ballast Rock Private Wealth.
Sure. We launched Ballast Rock Private Wealth late last year because we felt that accredited investors would benefit from a larger allocation of private assets in their portfolios. As we saw in 2022, the traditional portfolio of 60% stock and 40% bonds that's recommended by most advisors performed horribly. But if you look historically, private assets have outperformed their public counterparts at a much lower volatility. And institutional investors have shifted their asset allocations heavily to private assets over the past 2-3 decades, but it's been much slower for retail investors to get access or experience and expertise in allocating to those markets. So we think by adding a portion of private assets, whether that's private equity or private credit, to a traditional portfolio that contains stocks and bonds, you can create a diversified portfolio with better risk-adjusted returns.
Why do you think we've seen such an uptick in private credit?
Well, a lot has to do with the stress on the credit markets. Back in 2022, we saw issuance of debt down 75% from the year prior, and then that was only exacerbated this year in March with the failure of Silicon Valley Bank and the other stresses in the banking system. What that done is caused banks to really pare back their loan portfolios and keep more cash on hand to protect their balance sheets. In that space, though, because their companies still need credit in order to grow or make acquisitions, private credit has stepped into that space to provide the capital for these companies to grow.
Where specifically are you looking in the private credit market?
So we think that direct lending is the most attractive part of the private credit market at the moment. Direct lending is a subset of private credit where borrowers obtain loans from institutional investors and other specialized lending platforms. These loans sit at the top of the capital stack. They're senior secured first lien debt. So you don't need to go down the credit spectrum into high yield debt or levered loans to get very attractive returns. At the moment, the direct loan market is delivering returns close to 10%. Historically, they've been in the high single digits compared with high yield, which is around 5.7%, and even levered loans, which is down around 4.2%. So a higher yield, lower risk means better risk-adjusted returns for our clients.
Do you think these trends will continue?
We see them continuing at least for the next 12 to 24 months. The Fed has made it relatively apparent that they're going to keep interest rates higher for longer. Plus, given the failure of Silicon Valley Bank and the other stresses on the banking system, we think that there's more regulation coming down the pipe and potentially more strict capital ratios for banks. So that's going to really prohibit their ability to expand their loan portfolios. In that case, you're going to have direct lenders and private credit in general stepping into that space to provide loans to these companies so they can grow.
What should retail investors know about private credit? Is it liquid like a stock? Are there holding periods like a closed-end fund? What should they be aware of?
Sure. There is actually a number of different ways to access that market. There are interval funds and BDCs that offer the ability to subscribe to those funds on a monthly basis, sometimes even on a daily basis, and then they offer you quarterly liquidity if for whatever reason you want to get out of that trade. There are other more traditional drawdown structures, an LP-GP structure where you make a commitment. The GP will call your capital over a 2 or 3 year period, and then the typical life of that fund is about 7 or 8 years. So it all depends on what someone's long-term investment goals are and what their liquidity needs are on day one.
And then, of course, should they be working with an advisor to help them navigate this market, especially if they're new to it?
I think these markets, there's a lot of different strategies. There's a lot of different managers. We think it's critical to have an advisor that understands the market, is able to do the due diligence on the different managers and the different strategies in order to make the best recommendations for their clients.
All right, Christian, we appreciate the insight. Thanks for joining us.
Jill, thank you so much.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.